So guys, the list of mistakes that people make in the stock market is really long. But for some reason, the bear market tends to bring the worst in all of us, right? So that's why we are going to talk about 5 common mistakes that investors make during bear markets. Now, the mistake number 1 is checking their portfolios every day, right? For some reason, we have the compulsion that we have to log into our trading account every day and we have to check whether our portfolio is going up or going down, right? So this is what I tell people, that if your portfolio is looking ugly today, it is not going to become beautiful tomorrow. So basically what you need to understand is that things are not going to change overnight. It's going to take time, right? So this bear market is hurting everybody. You are not the only one who is suffering. So stop obsessing about your portfolio every day, because it will only create stress and frustration. Now, the mistake number 2 is panic selling. Now, every investor has a different risk appetite, but there are some investors out there who just cannot bear the stress of their stocks falling 10%, 15%, or even higher. So what they do is they decide to book the loss. But what they don't realize is that the market never moves up in a straight line from point A to point B. It always follows a zigzag path. So if you want to be a successful investor, you need to have the stomach to sit through these ups and downs. Now, the mistake number 3 is stopping SIPs. Now, this is the most counterintuitive thing that I have seen people doing. So let me ask you guys something. Isn't investing all about buying low and selling high? And if that is the case, then why are we being afraid to buy when the market is low, when we were perfectly happy to buy when the markets were at all-time high? Right? It doesn't make any sense. So please make sure that you are not stopping your SIPs, because this is a time where you're getting the great deal on the prices and you should not be missing that opportunity. Now, the mistake number 4 is not rebalancing the portfolio. Now, bear markets are excellent opportunities to rebalance your portfolio by moving some of the capital from debt to equity or from fixed deposits to equity. And that is exactly what most of these dynamic asset allocation mutual funds do, right? Automatically, when the markets are down, they move the fund towards equity. But we, retail investors, we are so scared of the market when the markets are down that we don't want to put any more money there, right? So what happens eventually is that we miss out on a great opportunity of averaging down our buying price. And that brings us to the mistake number 5, which is getting carried away with bad news. Now, one of the fascinating things about bear markets is that the level of pessimism grows very high, right? So every day there is some kind of a bad news that comes. Maybe it is regarding economic recession or job loss numbers or some stock falling 20% or 30%, right? So what happens is that some of us get overwhelmed by this series of negative news and start to completely give up on the stock market. But there is a saying in the stock market that is very profound, and what that says is that things are never as good as they seem, neither are they as bad as they seem, right? So just like our bodies go through periods of sickness and health, so does the stock market goes through cycles of bear market and bull market, right? So that is basically what I wanted to share with you guys. So my only message here is that instead of worrying about the bear market, we should start thinking about taking advantage of the bear market.